the $18,000 Medicare Lie that will bankrupt your retirement. Your Medicare budget probably isn't being drained by premiums. It's IRMAA surcharges, late penalties, and brutal bracket jumps most people never plan for. That's why solid retirements spring leaks. Many budgets miss this by $10,000 to $18,000 over just a couple of years, and it often shows up as a smaller Social Security deposit. Today, I'll show you the traps, the math, and legal ways to avoid them. Watch for the 2-year look-back gotcha, the one rollover that quietly triggers IRMAA, and a safe income plan that stays under thresholds. No scare tactics, just steps you can use this week. Thousands of retirees have fixed this with a few calendar tweaks. You can too. Let's fix the budgeting mistake first. The problem: why your Medicare budget is wrong. Most people do the right first step. They look up the Part B and Part D base premiums, plug those into a spreadsheet, and call it a day. The problem is that Medicare doesn't charge just a base price. If your income is above certain thresholds, IRMAA adds surcharges on top of Part B and Part D. Those surcharges tier up, and the tiers reset each calendar year. Miss that, and your safe budget is built on sand. Here's the thing most people miss: the 2-year look-back. Medicare uses your modified adjusted gross income, MAGI, from 2 tax years ago to set this year's Part B and Part D costs. So your 2025 premiums are based on your 2023 MAGI. That means the Roth conversion you did late in 2023 or the asset sale you made after retirement can blindside you in 2025. Timing isn't a detail here, it's the ball game. Now, why do budgets blow up? Because income in retirement isn't as simple as my pension plus Social Security. Required minimum distributions can push your MAGI higher as soon as they start. Roth conversions are great long-term, but if you jam a big conversion into a single year, you might cross an IRMAA tier by a few $100s and pay thousands more in premiums for the entire year. Asset sales, capital gains from rebalancing, a fund distributing gains you didn't ask for, any of those can kick you into the next tier. And once you cross the line by even $1, you're in the higher tier for the full year. There's no prorating. That's where the compounding pain shows up. A one-time spike doesn't just raise income taxes, it raises Medicare costs too. It's a double hit that repeats every month for a full year. If both spouses are on Medicare, the effect is duplicated. Medigap and Part D add another twist. Medigap premiums typically rise over time, and Part D plans change their formularies and cost structures. You might start with a reasonable total health budget at 65, then 5 years later find that Medigap increases and Part D drift have elevated your baseline, even before IRMAA shows up. If you only planned around averages, you were never aiming at the real target. Let me put a finer point on the average trap. Averages smooth out spikes, but IRMAA punishes spikes. If you aim at an average MAGI that's just below a threshold, a late-year capital gain distribution, or an extra IRA withdrawal for a home project can push you $1 over. Your budget could be off by thousands for the year, even though your average plan looked fine. You need to plan under thresholds, not around means. Another pain point: how you feel it. You don't get a separate red alert. If you're receiving Social Security, the higher Part B and Part D costs, including IRMAA, are withheld from your benefit. 1 month your deposit is lower, and it feels like a pay cut. If you aren't on Social Security, yet Medicare bills you directly, which can feel even worse because the bill lands in big chunks. And we haven't even touched filing status shifts. If a spouse passes away, single filer thresholds are tighter. The same income that kept you under a tier as a married couple can push you into IRMAA as a single filer. That change alone can turn a good plan into an expensive one if you don't adjust quickly. So the root causes are clear: ignoring IRMAA tiers, underestimating the 2-year lookback, letting income spikes land in the wrong calendar year, and relying on averages that hide risk. Add normal premium inflation for Medigap and shifting Part D plans, and the gap between your budget and reality grows. That's how people end up with that $10,000 to $18,000 shortfall over a couple of years. The fix starts with understanding what IRMAA is and exactly how it's calculated. Once you can see the thresholds and the timing rules, you can design around them. Because if you control your calendar, you control your cost. Let's decode IRMAA, so you know where the danger lines are before you step over them. IRMAA 101, what it is and how it's calculated. IRMAA is an income-related monthly adjustment amount. In plain English, it's a surcharge that gets added on top of your standard Medicare Part B and Part D premiums when your income is above certain thresholds. Think of the base premiums as the ticket price and IRMAA as the premium seating charge you didn't realize you triggered. It's not a one-time fee. It's a monthly increase that lasts the whole calendar year once you cross a line. Here's the core rule. IRMAA uses your MAGI, modified adjusted gross income, not your taxable income. MAGI starts with your AGI and then adds back certain items. The big one many people forget is tax-exempt interest from municipal bonds. If you've been hiding income in munis, it still counts for IRMAA. Roth conversions are fully included in MAGI, so are capital gains, IRA distributions, dividends, interest, and most other ordinary income items. If it hits your AGI, assume it matters here. Tiers are the next critical idea. Medicare sets several income tiers that determine how much extra you'll pay. These tiers are updated each year, and the thresholds differ for single filers and married filing jointly. Cross a tier by even $1, and the higher surcharge applies for the entire year. There's no smoothing, no prorating, and no close enough. That cliff effect is why managing to the threshold, not the average, is the winning approach. Timing is what trips up careful planners. Medicare uses a 2-year lookback. That means your premiums for a given calendar year are based on the MAGI reported on your tax return from 2 years prior. Example, 2025 IRMAA decisions use your 2023 MAGI. So a late 2023 Roth conversion, mutual fund capital gain distribution, or big IRA withdrawal can make your 2025 Medicare costs jump. You'll feel that as a monthly deduction increase or a bigger bill. How do you actually pay it? If you're already getting Social Security, the surcharges are withheld automatically from your benefits along with your base Part B premium. You don't opt in, it just happens. If you're not on Social Security yet, Medicare will bill you directly on a quarterly schedule. Either way, you pay the higher amount until the next annual determination, which reflects a different tax year's MAGI under the lookback. Let's talk about what doesn't work. You can appeal IRMAA because you made a voluntary financial move that raised your income. Roth conversions, elective IRA distributions, selling stock for a new car. Those are choices. Appeals are reserved for specific, life-changing events that reduce your income, like retirement, marriage, divorce, the death of a spouse, or a significant loss of income from a work stoppage. If you qualify, you can file to have Social Security use a more current, lower income figure. The mechanics of an appeal are straightforward, but time-sensitive. You'll provide documentation of the life-changing event and evidence of your current, lower income expectation. If approved, your IRMAA can be reduced mid-year. If your tax return later proves the lower income, you stay at the reduced level. If it doesn't, be ready for an adjustment. The key is that appeals fix genuine life changes, not planning oversights or elective transactions. Now, how does IRMAA hit both B and D? Part B IRMAA is one schedule of surcharges added to the Part B base premium. Part D has a separate IRMAA amount that gets tacked on to your drug plan premium. You don't pay the Part D IRMAA to the insurer, it's charged by Medicare. That means switching to a cheaper Part D plan won't remove IRMAA, though it can lower your non-IRMAA drug costs. The two surcharges are independent, but triggered by the same MAGI. There's a subtle point about couples. IRMAA determinations are individual, but based on joint MAGI. When you file jointly, if both spouses are on Medicare and your joint income crosses a tier, both spouses get the surcharge applied. That doubles the monthly impact. If one spouse isn't yet on Medicare, only the enrolled spouse pays the higher amount until both are enrolled. Let me give you a practical checklist so this clicks. First, identify the current IRMAA thresholds for your filing status. Second, add up your expected MAGI components for the year. Pensions, IRA distributions, Roth conversions, capital gains, dividends, interest, taxable Social Security, plus tax-exempt interest. Third, monitor your progress monthly or quarterly. If you're drifting toward a cliff, pause discretionary moves that add to MAGI and shift any needed spending to Roth or cash reserves. The reason this works is simple. IRMAA is math and timing. The math uses MAGI with add-backs. The timing uses a 2-year lookback that can help or hurt you depending on when income lands. Once you understand those two levers, you can predict your Medicare costs far more accurately. And once you can predict them, you can control them. Next, we'll map the total yearly damage, so you see exactly where that $18,000 exposure comes from. The $18,000 exposure, where that number comes from. Let's stack the real costs so you can see the shape of the problem. Start with the Part B base premium. Then add the Part B IRMAA if your MAGI crosses a tier. Do the same for Part D, your plan's premium plus the Part D IRMAA. Now layer in Medigap, which is separate coverage you buy to handle deductibles and coinsurance. Finally, add realistic out-of-pocket spending, copays, coinsurance, dental, vision, hearing, and over-the-counter. That composite number is your annual health cost. When IRMAA hits, it pushes two of those lines higher for a full year. Here's how one high MAGI year ripples through. Say your MAGI jumps because of a late year Roth conversion. 2 years later, your Part B and Part D surcharges rise for the entire calendar year. If both spouses are on Medicare, both pay the higher IRMAA. Multiply the monthly surcharge by 12 times 2 people. And it's easy to see several $1,000s evaporate without any change in your health. And because Medigap premiums usually increase with age and rating method, your baseline is already drifting upward. Where does the $18,000 figure come from? It's the cumulative effect of tiered surcharges across a year or two, compounded by normal premium inflation and drug plan drift. Imagine this. A couple crosses into a higher IRMAA tier for Part B and Part D for 1 calendar year. Between the two surcharges across 2 people, you're looking at a multi-$1,000 increase. Add that to your existing Medigap premiums and rising drug costs, and an unexpected $8,000 to $12,000 in year 1 isn't unusual. If your MAGI stays elevated another year, or the lookback captures another spike, the second year adds another chunk. That's how total exposure lands in the $10,000 to $18,000 range. Add-on risks make that number more likely. Required minimum distributions can force income you don't need, pushing you into a tier even if spending is flat. Capital gains from rebalancing a taxable account or a big mutual fund capital gain distribution you never asked for can stack on top of RMDs and dividends. Selling a home can also surprise you. While there's a home sale exclusion, gains above it count toward MAGI. If you sell appreciated property or a second home, that gain can lift you straight over an IRMAA cliff. Spousal dynamics matter too. Filing status can change your tier. If you file jointly today and one spouse passes away, The next year, your thresholds shrink as a single filer. The same portfolio income can suddenly trigger higher IRMAA. Or if one spouse keeps part-time income longer than planned, your joint MAGI can creep over a tier you thought you were avoiding. Even a modest one more year of work near retirement can echo into higher Medicare costs 2 years later because of the look back. Here's a concrete walkthrough. So the math feels real. Take a retiree couple with stable income from a small pension, Social Security, and modest IRA withdrawals. They plan a Roth conversion in November to reduce future RMDs. The conversion plus year-end mutual fund distributions in their taxable account pushes MAGI above an IRMAA tier by a few $100s. 2 years later, Part B and Part D surcharges apply for the entire calendar year for both spouses. Meanwhile, their Medigap rates rise with age, and their Part D plan changes its formulary, nudging out-of-pocket drug costs higher. Nothing went wrong with their health. The calendar did the damage. Now, layer in a second shock. The following spring, they sell appreciated shares to fund a car and home project. That creates another MAGI spike that shows up under the look-back the next year. They experience back-to-back IRMAA years. Add the 2 years of surcharges, the Medigap increases and the extra drug costs, and the unplanned total easily lands 5 figures. It's not that the system is unfair. It's that the rules are rigid and the cliffs are steep. The takeaway is simple. IRMAA turns calendar mistakes into annual bills. A one-time $1 breach is enough to move an entire year's premiums for both Part B and Part D. If both spouses are enrolled, each pays the surcharge. If thresholds tighten due to filing status changes, the penalty can arrive when you're least able to absorb it. Add normal Medigap inflation and drug plan drift, and your baseline cost rises while IRMAA adds spikes on top. Once you see the stack, Part B base plus IRMAA, Part D base plus IRMAA, Medigap, and out-of-pocket, you can reverse engineer your safe income. Manage MAGI below the tier, and you remove 2 big multipliers. In the next section, we'll map the most common landmines that push people over the line, so you can spot them before they trigger a year of higher costs. The triggers most people Mississippi. Let's surface the landmines that quietly push MAGI over a tier. The first is Roth conversion timing in the 2 years before Medicare starts. A big pre-retirement conversion at 63 can raise your 65-year premiums because of the look-back. Conversions are powerful, but the mistake is doing one oversized push instead of several smaller ones. The fix: size conversions to sit under your chosen tier and stop the moment your tracker says you're within a safe buffer. Next, large IRA distributions for big purchases. New roof, car, or helping a child. Those are common and valid goals. But pulling the full amount from a traditional IRA dumps taxable income into 1 calendar year. Add dividends and a small capital gain, and suddenly you've crossed the cliff. The better move is a blend. Take part from taxable accounts, part from IRA only up to your tier target, and cover the rest from Roth or cash reserves so MAGI stays controlled. Capital gains from selling appreciated mutual funds are another sneaky trigger. Mutual funds can also pass out year-end capital gain distributions in taxable accounts even if you didn't sell. If that hits in November or December after you've already done a Roth conversion, you may learn about the distribution when it's too late to offset. Favor tax-efficient ETFs, and before year-end, check expected distributions and harvest losses proactively to neutralize gains. Non-qualified deferred compensation payouts create surprise spikes when they finally pay. Same with post-retirement sales of employer stock, especially if you've got low basis shares. Those payouts often land in 1 or 2 tax years, and they're fully in MAGI. Coordinate with the plan sponsor where possible to spread payments, or counterbalance in the same year with lower IRA withdrawals and 0 Roth conversions. If you can't change the payout timing, adapt everything else around it. One-time income during the retirement gap, severance bonuses, or that last consulting project can feel harmless because I'm retired now. But it still counts 2 years later for Medicare. If you want to consult, consider earning in a year when you're still pre-IRMAA lookback, or keep it small enough to sit inside your tier cushion. Also, set aside tax and IRMAA buffers from that income, so it doesn't blindside your cash flow later. Inherited IRA mistakes are a big one. Beneficiaries sometimes take lump sum distributions for simplicity. That's a direct hit to MAGI. Even with the 10-year rule for most non-spouse beneficiaries, you can spread withdrawals to avoid spikes. If you're the beneficiary and already on Medicare, coordinate inherited IRA withdrawals with your existing distributions so the combined total stays under your tier. Rebalancing in taxable accounts is a quiet culprit. Rebalancing is good risk control, but doing it all at once after a bull run can realize large gains. Use specific lot identification and trim the highest basis shares first. And if you need to cut risk fast, consider rebalancing inside IRAs and Roths where there's no capital gain impact, then make smaller, targeted moves in taxable accounts to finish the job without blowing up MAGI. Another overlooked trigger: interest rates. Higher yields mean your safe bond interest is larger, and municipal bond interest adds back to MAGI for IRMAA purposes. If you shifted to munis to reduce taxes, remember they still count here. Keep an eye on your year-to-date tax-exempt interest and treat it like any other income in your tracker. Charitable giving timing can help or hurt. Writing checks from your checking account doesn't move MAGI, but missing the chance to use qualified charitable distributions after 70 and a half is costly in RMD years. If you plan to give QCDs, let those dollars bypass your AGI, which can be the difference between staying under or crossing a tier. Donor-advised funds can bunch deductions in high-income years, but the deduction doesn't reduce MAGI components like RMDs or conversions. It just reduces taxable income. Know the distinction. Finally, late-year stacking is where careful plans die. A year-end conversion, mutual fund distribution, and an ETF sale for a remodel can combine into an avoidable spike. The solution is a calendar rule. Freeze elective income moves after October unless your tracker shows ample room. If you need year-end flexibility, create a Roth or cash buffer earlier in the year, so surprises don't force taxable withdrawals in December. You can't avoid taxes forever, but you can control the calendar. Identify which of these triggers applies to you, build a safe buffer under your target tier, and give yourself a hard stop date each year. That's how you turn IRMAA from a surprise bill into a predictable line item you manage on purpose. Better method: design around thresholds, not averages. The game changer nobody talks about is designing your retirement income around IRMAA thresholds, not averages. Averages lull you into false security. Thresholds are cliffs. So we set a target MAGI aligned to your filing status and manage to that cliff with a safety buffer. Think of it like a speed limit with a radar gun. You don't drive at exactly 65, you sit at 61 to 62 to avoid a ticket. Same idea here. Pick the tier, then stay 3 to 5% under it to absorb surprises. Now, how do you actually do that? Start by building a withdrawal order that gives you control, led with taxable accounts, because you can steer capital gains with specific lot sales and harvest losses to offset gains. That frees you to fill only the amount of traditional IRA withdrawals that fit inside your MAGI target. Then keep Roth as your precision tool. Roth withdrawals don't count toward MAGI, so they're the pressure valve for spending above your target without IRMAA blowback. Once you nail that, everything else clicks. Loss harvesting isn't just for taxes, it's an IRMAA tool. Realized losses can neutralize realized gains, keeping MAGI flat even when you raise cash. Use exchange for similar ETFs to maintain market exposure without wash sale issues. The thing most people miss is how small, frequent maintenance trades beat one big cleanup in December. Monthly or quarterly adjustments keep you below the line with less drama. Here's the shortcut nobody teaches. Decouple your retirement timing decisions. You can delay Social Security to age 70 for higher future benefits while starting Medicare at 65. That can lower MAGI in your early Medicare years if Social Security taxation would otherwise push you over a tier. It also makes room for modest Roth conversions in those years without crossing a threshold. If you remember nothing else, remember that Social Security and Medicare don't have to start together. Qualified Charitable Distributions are a quiet powerhouse starting at 70 and a half. If you already give annually, send those dollars directly from your IRA to charities. That satisfies part of your RMD without raising AGI, which in turn keeps MAGI lower for IRMAA. QCDs don't require itemizing, and the dollars never pass through your income. That's pure IRMAA management. Contrast that with donating cash. Helpful for deductions, but it won't pull MAGI down. Spread income events instead of stacking them. Ladder Roth conversions over multiple low-income years, especially before RMDs start. A series of small conversions can shift future RMDs lower without ever tipping you over a current tier. The mistake is doing a single, oversized conversion that saves future taxes but triggers an immediate IRMAA year. Use a conversion cap equal to your MAGI target minus your other income, and stop the moment you hit it. Actually, let me back up and make this even clearer. Start each January with your tier target and a 3 to 5% buffer. Project your baseline income. Pensions, dividends, interest, and any scheduled IRA withdrawals. That gives you the room available for elective moves, small conversions, targeted capital gains, or none at all. If markets are up, harvest gains inside tax-advantaged accounts and use losses in taxable. If markets are down, harvest taxable losses early and bank the flexibility for later in the year. Before we continue, you need to understand how small buffers save big money. A $1 breach can cost thousands over a year. So a 3 to 5% cushion turns nasty surprises, mutual fund distributions, slightly higher interest, a necessary repair, into non-events. Protect the buffer by making a simple rule. After October 15th, no elective income moves unless your tracker shows at least the full buffer remaining. If you need cash, tap Roth or an existing cash reserve. Let me show you exactly how this plays out. Suppose your tier target is $194,000 MAGI as a married couple, and your baseline projection is $172,000. That leaves $22,000 of headroom. Reserve 5% of the threshold, about $9,700, as a buffer. Now you have roughly $12,300 for elective moves. You could do an $11,000 Roth conversion in June and still hold room for a modest capital gain later. If an unexpected $3,000 mutual fund distribution lands in December, you're still under the line. The reason this works is discipline and measurement. You're not trying to minimize taxes at all costs. You're optimizing lifetime costs by keeping both taxes and IRMAA in check. Manage to the tier, blend your accounts, and use QCDs when eligible. Spread conversions and decouple Social Security if it gives you cleaner early years. Strategy only sticks if you can measure it. So next we'll build your MAGI tracking system to make these decisions automatic. Implementation. Build your IRMAA-Safe income plan. Start with an inventory. List every income source that can touch MAGI. Pensions, wages, or consulting, traditional IRA distributions, Roth conversions, taxable interest, dividends, capital gains, Social Security, the taxable portion, rental net income, and tax-exempt municipal interest. Next to each, add how often it hits, monthly, quarterly, or ad hoc, and whether you control the timing. Control is the lever. Fixed pension? Note it as baseline. Roth conversion? Mark it as elective. Now estimate your MAGI with add-backs. Take last year's tax return. Line items for AGI plus the tax-exempt interest number. Replace last year's numbers with this year's estimates for each category. If you hold mutual funds and taxable accounts, check the fund company's distribution calendar and last year's percentage of NAV distribution to avoid surprises. If rates rose and you hold munis, increase your tax-exempt interest estimate. Build this in a simple spreadsheet that totals year-to-date actuals and full-year projections. Create a year-by-year map from age 60 through 75. Why that span? It covers your pre-Medicare window, the IRMAA Lookback Danger Zone, early Medicare years, and the RMD onset. For each year, note 3 things: your expected filing status, your targeted IRMAA tier for that year, and which tax moves fit. For ages 60 to 63, prioritize tax-efficient rebalancing and small Roth conversions if your income is naturally low. For ages 63 to 65, remember the look back. Income here influences Medicare at 65 to 67. Flag those as clean years unless you've budgeted headroom. Choose your withdrawal order with intention. Start with taxable accounts for plan spending because you can use specific lot sales to manage realized gains. Fill your desired ordinary income bucket with partial IRA distributions to the bracket you want, never to the threshold line. Keep Roth for shocks, big purchases, and late year needs. That order gives you 3 dials: capital gains, ordinary income, and IRMA neutral cash. Each month, track progress and update your projection. If markets rally and your mutual funds project bigger distributions, trim elective moves elsewhere. Time Roth conversions where they help without harm. The sweet spots are pre-Medicare years and low MAGI years after Medicare, when you still have room under your chosen tier. Set a conversion cap equal to your target MAGI minus projected baseline income minus a 3 to 5% buffer. Execute conversions earlier in the year, then pause to reassess mid-year. If unexpected income shows up, you've got time to stop. If things are quiet, you can add a small top-up conversion in late summer and still protect the buffer. Coordinate with RMDs at your required age. Project the first RMD amount using your current IRA balances and the IRS table, so you aren't surprised if that number alone risks breaching your tier. Fix it now by finishing modest conversions in prior years or by planning qualified charitable distributions to offset part of the RMD without raising AGI. If you already give to charity, set up QCDs at 70.5 and automate them early in the year so they reduce your taxable RMD from the start. Use charitable tools and deductions strategically. Donor-advised funds are best in years when you must realize large capital gains, say, selling a concentrated holding. You front-load several years of giving into one high-gain year to reduce your taxable income, then grant to charities over time. Remember, this lowers taxable income, but doesn't remove MAGI drivers like RMDs or conversions. Treat it as a tax rate smoother, not an IRMA eraser. Pair the plan with a calendar. In January, set your target tier and buffer. In March, run your first MAGI checkpoint, tally actuals, update projections, and decide if you have room for a spring conversion. In June, reassess after dividend season. In September, freeze elective income if your remaining headroom is less than the buffer. After October 15th, only tap Roth or cash for new spending unless your tracker shows abundant room. Now, dial in cash flow mechanics. Set a safe harbor draw from taxable and IRA sources that keeps monthly inflows under the pace needed to stay below your tier. If you need an extra $5,000 for travel, pull from Roth by default. If you must sell in taxable, identify high basis lots to minimize gains and offset with harvested losses. Keep a 6 to 12-month cash reserve, so you're never forced into a taxable sale in December. Finally, document rules of engagement. Write 3 lines: my target MAGI, my hard buffer, and my stop date for elective moves. Add 2 if-then rules. If projected MAGI crosses 90% of target, pause conversions. If realized capital gains exceed plan, reduce IRA withdrawals to maintain room. Share the plan with your spouse and advisor, so everyone knows the guardrails. With this structure, you can make spending decisions confidently, knowing you're steering clear of IRMAA cliffs. Guardrails, tools to keep you under the line. Let's put rails on the road so you don't drift over a cliff. Start with quarterly MAGI checkpoints. In March, June, September, and early December, total year-to-date actuals for every MAGI item. IRA withdrawals, Roth conversions, interest, dividends, realized gains, taxable Social Security, rental net income, and tax-exempt interest. Project the full year based on what's left on the calendar. If the projection crosses 90% of your target tier, pause elective income and switch spending to Roth or cash. This single habit prevents most late-year blow-ups. Safe harbor distributions keep your monthly inflows on pace. Set a fixed monthly draw that, when annualized, lands under your tier with your buffer intact. For example, if your annual MAGI target is $170,000 and baseline non-negotiable income is $120,000, you've got $50,000 of room before buffer. That's about $4,000 a month. Automate $3,500 from IRA and taxable, then use Roth for any top-ups. If your tracker says you've got headroom mid-year, you can increase temporarily. If not, hold the line. Control capital gains with 3 levers. First, favor ETFs over active mutual funds in taxable accounts because ETFs generally distribute fewer capital gains. Second, use specific lot identification so you can sell high basis shares first and keep realized gains small. Third, harvest losses deliberately. If a holding is down, realize the loss and swap into a similar ETF to maintain exposure. Bank those losses for flexibility later in the year when an unexpected gain shows up. Roth is your shock absorber. Any expense that would push MAGI over the line gets funded from Roth first. New roof, medical dental work not covered by insurance, big travel, default to Roth. That lets your spending match your life without rewarding Medicare with a surcharge. The trick is to pre-plan. Keep a healthy Roth balance accessible and rebuild it in low-income years with modest conversions that still sit under the tier. If you have an HSA, use it with intention. Qualified medical expenses paid from an HSA are tax-free and IRMAA neutral. If you've saved receipts from prior years, you can reimburse yourself now without touching MAGI. That's powerful in a year when you're close to a threshold. Pair HSA reimbursements with a pause in IRA withdrawals, and you can glide through the calendar without tripping a surcharge. Install calendar rules. After October 15th, no elective income unless your tracker shows room beyond the full buffer. No late-year Roth conversions, no big taxable sales, and no mutual fund switches in taxable unless you verify distribution dates and amounts. If you must raise cash, start inside IRAs or Roths to avoid gains. Then take the smallest taxable sale possible and offset with existing losses. Use if-then guardrails for discipline. If projected MAGI exceeds 95% of target, stop conversions immediately and switch all extra spending to Roth or HSA. If realized capital gains reach your annual cap, any rebalancing must happen inside IRAs and Roths only. If interest rates rise and your year-to-date tax-exempt interest accelerates, reduce IRA withdrawals by the same amount to keep totals steady. Coordinate spousal income. When both spouses are on Medicare, tier breaches double. Stagger elective moves, so only one spouse receives taxable distributions when possible. Pensions and RMDs may be fixed, but Roth TAPs and taxable sales can be assigned. If one spouse expects part-time income, reduce that year's IRA distributions to compensate, and delay any conversions until the following year. Finally, keep documentation. Save quarterly checkpoint snapshots, spreadsheets, brokerage gain/loss reports, and fund distribution notices. If an unexpected distribution hits, those records help you pivot fast and explain decisions to your advisor. They also make next year's projections more accurate. Guardrails aren't about saying no. They're about saying yes to the right cash source at the right time, so you stay under the line without shrinking your lifestyle. When you've already triggered IRMAA, damage control. First, confirm the numbers. Don't assume Social Security's IRMAA letter is flawless. Pull your most recent IRS transcript and your filed return for the look-back year. Check MAGI math, AGI plus add-backs like tax-exempt interest. Verify filing status. Make sure there isn't double-counted income, a missing basis adjustment on a sale, or an incorrect rollover classification. If something's off, call Social Security and request a reconsideration with supporting documents. Next, ask if you qualify for a life-changing event appeal. This isn't about voluntary moves. It's for events that reduce income, retirement or work stoppage, marriage, divorce, death of a spouse, loss of pension income, or loss of income-producing property. If one of those applies after the look-back year, file right away. Use the official appeal form and include evidence, retirement, letter, death certificate, new pay stubs, or benefit statements. The quicker you file, the sooner your premium can adjust. If you've retired recently, spell out the new income reality. Provide an estimate of current year MAGI and explain why it's durably lower than the look-back year. If approved, Social Security can base IRMAA on the new figure. If your later tax return confirms that lower income, the reduced IRMAA holds. If your actual income ends up higher, they'll true it up. The key is honest, well-documented expectations. No appeal grounds, shift to mitigation. The goal is to make this IRMAA year the last one. Cut MAGI for the current tax year now, so the look-back 2 years from today reflects a lower figure. Pause Roth conversions, cancel elective IRA withdrawals, and move large expenses to Roth or cash. If you must raise cash in taxable, sell high-basis lots, and harvest losses to offset gains. Tighten dividends by moving income-heavy funds into tax-advantaged accounts, where possible. Coordinate with charity if you're 70 and a half or older. Use Qualified Charitable Distributions to satisfy part of your RMD without raising AGI. Turn off automatic withholding on RMDs you'll offset with QCDs, so the dollars never hit MAGI. If you already give annually, route it through QCDs first. That single change can be the difference between another IRMAA year and a clean one. Revisit your monthly draws. Install a safe harbor distribution sized below your tier target for next year's look-back. Automate that amount and default all top-ups to Roth. Add a hard stop rule. If your year-to-date MAGI projection exceeds 90% of your target, no more elective income for the year. That prevents a second surprise. Trim non-IRMAA costs while you wait for the reset. During Part D open enrollment, reshop your drug plan based on your current medications and preferred pharmacies. Small plan changes can shave hundreds, even though Part D IRMAA itself won't budge. With Medigap, review rate increases and consider carriers with lower current premiums for the same lettered plan, subject to underwriting rules in your state. If you're healthy and disciplined, evaluate high-deductible plan G paired with a dedicated medical reserve. Check timing interactions. If a deferred comp payout or stock vesting is locked in this year, accept the hit and protect next year. Pause conversions, shift rebalancing inside IRAs and Roths, and push any discretionary sales into a low-income year. If a home or asset sale is planned, model the gain. And, if possible, split closings across tax years or use an installment sales structure to avoid a single-year spike. Tighten your documentation. Keep a simple IRMAA folder, latest SSA determination, your MAGI tracker, fund distribution notices, and any appeal filings. If Social Security misapplies filing status or uses an outdated return, you'll have everything ready to respond fast. Finally, reset expectations and move forward. One IRMAA year isn't failure. It's feedback. Use it to harden your guardrails, earlier checkpoints, a wider buffer under the threshold, and a strict late-year freeze on elective income. The win is securing next year's lower MAGI, so the following Medicare year drops back to base. Control the calendar now, and you won't repeat the surcharge. Common mistakes that blow up your plan. Ignoring the 2-year lookback when you make late-year moves is mistake number 1. You do a smart Roth conversion in November because markets dipped, then a mutual fund drops a capital gain in December. 2 years later, your Medicare premiums jump for a full year. The fix is a standing rule. Run a MAGI checkpoint before any November or December transaction, and freeze elective income if you're within your buffer. Forgetting that tax-exempt interest adds back into MAGI is another costly slip. Municipal bonds don't reduce IRMAA exposure. The interest still counts. If you shifted to munis to lower taxes, update your tracker with year-to-date tax-exempt interest. If higher rates boosted that income, reduce IRA withdrawals by the same amount to keep your projection steady under the tier. Taking the full RMD in December feels convenient, but stacks risk. December is when dividends, fund distributions, and last-minute sales pile up. Pulling the entire RMD then can push you into the next tier without time to correct. Spread RMDs across the year or front-load QCDs after 70 and a half, so part of the required amount never touches AGI. Monthly or quarterly RMDs smooth the inflow and preserve your buffer. Letting a spouse's death blindside your filing status is painful and common. As a widow or widower, your IRMAA thresholds shrink. The same portfolio income that kept you safe last year can now trigger surcharges. If you're newly single, rebuild your MAGI target immediately using single filer thresholds. Pause elective income for the rest of the year, and consider shifting spending to Roth to avoid an automatic tier breach. Underestimating mutual fund. Capital gain distributions in taxable accounts is another trap. Funds may distribute gains even in flat markets. If you hold active funds, check the company's distribution estimates by October and plan offsets. Better yet, migrate to broad market ETFs in Taxable, which are generally more tax efficient. Use specific lot ID so you can raise cash with minimal realized gains. Treating Roth conversions as use it or lose it is a mindset mistake. You don't need to fill every tax bracket every year. If your projection drifts near 90% of your IRMAA target, stop conversions and wait for a better year. A smaller, well-timed conversion beats a big one that buys you an IRMAA year. The goal is lifetime optimization, not single-year maximization. Paying large expenses from traditional IRAs by default is another avoidable error. New roof, vehicle, or a family gift. If those withdrawals land in one calendar year, they inflate MAGI. Blend sources. Sell high-basis lots in Taxable. Use Roth for the remainder, and limit IRA withdrawals to the space under your tier. If you regularly face lumpy costs, build a dedicated cash reserve, so you're not forced into taxable income in Q4. Rebalancing only in taxable accounts after a rally is a quiet MAGI booster. Realizing gains to cut risk is smart. Doing all of it in Taxable at once isn't. Rebalance inside IRAs and Roths first, where there's no gain impact. Then trim the edges in taxable using high basis lots. If you must realize gains in taxable, pair the sales with harvested losses and keep the net result inside your cap. Assuming charitable deductions, lower MAGI is a technical slip. Cash gifts may reduce taxable income, but they don't pull down AGI components that drive IRMAA. After 70 and a half, prioritize QCDs to move charitable dollars straight out of your IRA without touching AGI. If you front-load giving with a donor-advised fund in a high-gain year, great. Just remember it won't erase RMDs or conversions in MAGI. Finally, skipping documentation. No tracker, no calendar, no distribution estimates. That's how good intentions become IRMAA bills. Keep a simple spreadsheet with year-to-date AGI components, tax-exempt interest, and projected totals. Review in March, June, and September, and adopt a hard stop after October 15th for elective income. When in doubt, by time, shift spending to Roth or HSA and reassess in January. Control the calendar, and you control the cost. Quick wins you can do this week. Let's lock in fast wins. First, pull your last 2 filed tax returns. Find AGI and tax-exempt interest, then note any Roth conversions, IRA withdrawals, capital gains, and dividends. That gives you the look back year and a baseline. Open the current year-to-date statements from your brokerage and bank. List what's already hit. Interest, dividends, realized gains, IRA distributions. You'll spot early if you're trending toward a tier. Now set a MAGI target for this year using the current IRMAA thresholds for your filing status. Pick the tier you want to stay under and build a 3 to 5% buffer. Write 2 numbers on a sticky note, target and buffer. Put it next to your computer. Build a simple tracker, 1 column for each MAGI item, a year-to-date total, and a full-year projection. Update it monthly. If your projection hits 90% of target, pause elective income. Next, make your portfolio more tax efficient. In taxable accounts, switch from active mutual funds to broad market ETFs where it fits your strategy. ETFs generally have lower capital gain distributions, which reduces surprise MAGI. At your brokerage, enable specific lot identification so you can sell high basis shares first. While you're there, download last year's fund distribution percentages and this year's preliminary estimates to avoid late year surprises. Set up a Roth conversion window with a hard stop. Calculate the room available. Target MAGI minus projected baseline income minus your buffer. Schedule a small, early conversion. Think spring or early summer. Then stop. Mark a mid-year review date. Only consider a top-up conversion if your tracker still shows clear room. If you're within the buffer, skip it. A clean year beats a forced surcharge. If you're 70 and a half or older and you give to charity, set up Qualified Charitable Distributions now. Call your IRA custodian, complete their QCD form, and route your regular giving directly from the IRA. Turn off withholding on the portion you'll satisfy via QCDs, so those dollars never hit AGI. Put the QCDs on a quarterly schedule to smooth your RMD throughout the year. Create a cash and Roth spending rule for any large purchase this year. Home repair, car, dental, default to Roth or cash, not traditional IRA, unless your tracker shows abundant space. Add a calendar alert after October 15th. Freeze elective income moves. If you need cash after that date, tap Roth first. This single habit shuts down most late year stack-ups. Do a quick Part D checkup. Visit the Plan Finder. Enter your current medications and compare your plan against the top 2 alternatives. If your drug mix changed, note potential savings for open enrollment. While you're at it, call your Medigap carrier and ask about rate history and any household discounts. Put a reminder on your calendar to reshop during your state's switching window. Harvest easy tax losses now if markets gave you candidates. Sell the down position, swap into a similar ETF to maintain exposure, and bank the loss to offset future gains. Record the wash sale window so you don't repurchase too soon. Finally, write your 3 guardrails on paper: this year's MAGI target, your hard buffer, and your stop date for elective income. Add 2 if-then triggers. If projected MAGI crosses 90% of target pause conversions, if realized gains exceed plan, reduce IRA withdrawals. Share this with your spouse or advisor this week so everyone is aligned. Small moves right now prevent big IRMAA bills later. Optimizing Part B/D/Medigap without overpaying. Now, let's trim the parts of your Medicare bill you can control without touching MAGI. Start with Part D because it's the most flexible. Plans change formularies, preferred pharmacies, and copays every year. What was cheapest last year often isn't this year. Use the plan finder during open enrollment. Enter your exact medications and dosages and compare total annual cost, premium plus copays and deductibles at your preferred pharmacy and a mail option. The lowest premium isn't always cheapest overall. Lock the one with the lowest total out-of-pocket. If you take pricey brand medications, look at tier exceptions and preferred alternatives. Ask your doctor if a therapeutically equivalent generic works. Then verify that choice inside the plan finder. A single drug swap can save hundreds even when IRMAA is unchanged. Also check for pharmacy alignment. Switching to the plan's preferred chain or mail order often cuts copays instantly. Now, the big fork: Medigap versus Medicare Advantage. This isn't about better, it's about what you value. Medigap paired with Original Medicare gives you national access and predictable costs. Medicare Advantage can offer lower premiums and extras, but uses networks and prior authorizations. If you travel or have complex providers, Medigap usually buys peace of mind. If your care is local and routine, an Advantage HMO or PPO might fit your budget. Either way, Part D IRMAA still applies separately if you have drug coverage. If you choose Medigap, understand the plan letters. Plan G is the most popular for new enrollees. It covers nearly everything except the Part B deductible. Plan N trades lower premiums for potential copays and possible excess charges in rare cases. The benefits for the same letter are standardized across insurers, but premiums aren't. Shop multiple carriers for the identical lettered plan. Rate type matters. Attained age policies often start lower, but increase as you age. Community-rated policies charge the same to everyone in a region, so increases tend to reflect overall claims rather than birthdays. Issue age policies lock the rate based on your age at purchase. Ask each insurer which rating method they use and request a 5-year rate history. A low teaser rate that jumps aggressively can cost more over time than a slightly higher, steadier option. Consider high deductible Plan G if you're healthy and disciplined. You accept a higher annual deductible in exchange for meaningfully lower premiums. Then keep a dedicated medical reserve to cover that deductible. The math can work if you rarely need care and you actually set aside the savings. Treat it like an HSA mindset. Premium savings go straight to your reserve, not into general spending. If you're eyeing Medicare Advantage, scrutinize the network and the out-of-pocket maximum. Confirm your doctors, specialists, and hospitals are in-network now, not expected. Check prior authorization rules for imaging and therapies you know you'll use. Look at the annual maximum and ask yourself if you could handle that in a bad year. If not, Medigap's predictability might be worth the premium. Align coverage to your prescriptions and providers. If you rely on a specific specialty clinic, Original Medicare plus Medigap offers simpler access. If your drugs drive costs, prioritize a Part D plan that handles those medications well and pairs with your chosen pharmacy. Avoid paying for extras you won't use. Dental, vision, and hearing add-ons and Advantage are only valuable if the coverage matches your expected use and providers. Shop annually. For Part D, recheck every open enrollment. Formularies move. For Medigap, watch your state's rules. Some states allow switching without underwriting during certain windows. Others require medical underwriting. If you can switch, get quotes for the same letter from multiple carriers. Ask about household discounts and electronic payment discounts, which can shave a few percent. Don't chase pennies at the expense of predictability. The goal is a stable, IRMAA-aware budget. A slightly higher Medigap premium that's steady can beat a lower one with steep increases. A Part D plan that keeps your key brand on a preferred tier can save more than a rock-bottom premium with brutal copays. Always compare the full-year math. Premiums plus expected cost sharing. Finally, coordinate coverage choices with your income plan. If you expect a low-income year, you might accept a slightly higher Part D premium for better drug savings. If you anticipate medical procedures, a richer Medigap letter can reduce surprises. Coverage and cash flow should support each other, not fight. Tighten coverage now, and you'll cut the noise so your IRMAA strategy does the heavy lifting. The multi-year playbook, ages 60 to 75. Let's turn strategy into a calendar you can actually follow. From 60 to 75, your goals shift. Reduce future forced income. Keep MAGI clean during key lookback years, and enter RMDs with control. We'll break it down by phase so you know exactly what to do, when to do it, and what to avoid. Ages 60 to 63. This is your prep window. Your mission is to lower future RMDs and clean up your taxable account. Start by harvesting losses and moving from active mutual funds to broad ETFs in taxable to reduce surprise distributions. If your natural income is moderate, execute modest Roth conversions sized to your tax bracket and IRMAA-free targets. Remember, these years won't hit Medicare yet, but they can affect later Social Security taxation. Consolidate small IRAs to simplify RMD tracking and build a 6 to 12-month cash reserve so you're never forced into a late-year taxable sale. Also at 60 to 63, rebalance inside IRAs and Roths first. In taxable, trim risk using specific lot sales to keep realized gains minimal. If you hold concentrated positions, plan a gentle exit over several calendar years, pairing any necessary gains with harvested losses. And document your baseline income so you know how much room you have each year for elective moves. The more you reduce future forced distributions now, the easier your Medicare years will be. Ages 63 to 65. This is the danger zone. The 2-year lookback means income here sets Medicare costs at 65 to 67. Treat these as clean years. Keep MAGI well below your chosen IRMAA tier with a 3 to 5% buffer. If you still want conversions, they must be small and early in the year, then pause by fall after a checkpoint. Avoid selling appreciated mutual funds in taxable during Q4 and verify fund distribution calendars by October. If you're finishing a job or taking a bonus, model the effect carefully. Even a small overshoot can trigger a full year of surcharges later. If you plan to retire in this window, time your last paycheck and any severance to avoid stacking with other income. If you can choose payout timing for deferred comp, push it to a pre-Medicare year if possible, or spread it. Tighten dividends by holding high-yield assets in IRAs. If you give to charity and you're not yet 70 and a half, consider bunching deductions in one tax year with a donor-advised fund to offset needed gains, while remembering it won't lower MAGI drivers. Ages 65 to 67. You're on Medicare now. Keep these early Medicare years as clean as possible. Consider delaying Social Security for higher future benefits while using taxable and modest IRA withdrawals for spending. This often lowers MAGI and protects your IRMAA tier. Use Roth for any large purchases so you don't inflate MAGI. Reshop Part D annually and audit Medigap premiums, but don't chase tiny savings if it risks coverage stability. Run quarterly MAGI checkpoints. If a surprise distribution shows up, pause elective income immediately. If you need to do any Roth conversions in this phase, keep them small and only when your tracker shows clear headroom. Your goal is simplicity, predictable cash flow, minimal taxable surprises, and excellent documentation. The cleaner these years are, the more flexibility you'll have later. Ages 68 to 71. The pre-RMD tune-up. Forecast your first RMD using current balances and the IRS table. If the projection threatens your IRMAA tier, accelerate modest conversions now. Again, only within your headroom. Shift income-heavy assets into tax-deferred accounts and hold tax-efficient equities in taxable. If you have appreciated positions, continue targeted trims paired with losses. At 70 and a half, turn on qualified charitable distributions if you give. Set them on a schedule so they reduce RMD impact the moment RMDs start. Also, stress test a high expense year. If you needed $20,000 for a project, where would it come from without crossing the tier? Practice using Roth and cash first. Finalize a safe harbor monthly draw that keeps your annualized MAGI under target with buffer. Install your late year freeze date, October 15th, and make it non-negotiable. RMD start, usually age 73 for many, depending on current law. Pair RMDs with QCDs if you're charitable. If the RMD still risks your tier, lower other ordinary income. Reduce elective IRA withdrawals and avoid conversions that year. Use taxable high basis sales and harvested losses for cash, and lean on Roth for any large spend. Keep quarterly checkpoints tight. If your MAGI projection creeps past 90% of target, cut ordinary income and stop elective gains. Widow or widower planning can't wait. Single filer thresholds are tighter, so the same portfolio income hits harder. If your spouse is ill or you anticipate a transition, lower future RMDs now with careful conversions while you still file jointly. Move essential cash to Roth for the survivor's use. After the status change, immediately rebuild the plan using single thresholds, widen the buffer, and freeze elective income for the rest of that year. Throughout 60 to 75, the pattern repeats. Forecast, measure, and adapt. Each January, set your tier and buffer. Each quarter, reconcile your tracker and update decisions. Each fall, freeze elective income and use Roth or cash for surprises. Coordinate coverage choices with your income plan so non-IRMAA costs stay predictable. Do this, and you steer the calendar instead of reacting to it, keeping Medicare affordable without shrinking your lifestyle. Annual IRMAA checklist. Let's lock this into a simple, repeatable checklist you'll run every year. Do this in 5 passes. Thresholds, projection, moves, coverage, and confirmation. January, confirm thresholds. Look up the current IRMAA tiers for your filing status. Write 2 numbers, your chosen tier ceiling and a 3 to 5% buffer below it. Add your stop date for elective income, October 15th. Share these with your spouse or advisor so everyone's aligned from day one. Early February, build your baseline projection. List each MAGI driver and its expected amount this year. Pensions, Social Security, taxable portion, IRA withdrawals, Roth conversions planned, interest, dividends, capital gains, rental net income, and tax-exempt interest. Use last year's 1,099s and fund distribution histories as a starting point. Note which items are fixed versus elective. Tally a full year estimate and compare it to your tier minus buffer. That gap is your headroom for optional moves. March checkpoint. Reconcile reality with the plan. Pull year-to-date statements. Add actuals for each MAGI line and refresh your full-year projection. If projected MAGI exceeds 90% of your target, pause conversions and reduce elective IRA withdrawals. Switch any near-term cash needs to Roth or cash. If you're comfortably under, schedule a small spring conversion capped by your remaining headroom. April, June, control capital gains. Turn on specific lot identification at your brokerage. If you need to raise cash, sell high basis lots first. Proactively harvest tax losses if markets dip, swapping to similar ETFs to keep exposure. Move income-heavy funds from taxable into IRAs during rebalances and keep broad, tax-efficient ETFs in taxable. Document harvested losses. You'll use them to offset any surprise gains later. June checkpoint. Update actuals through dividend season and reproject. If you still have room, consider a modest top-up conversion now, not later. Rebalance inside IRAs and Roths first. In taxable, make only targeted trims that fit within your gain cap. If muni yields increased, adjust your tax-exempt interest estimate and offset by reducing other ordinary income. September, prep for year-end pitfalls. Check your mutual fund's preliminary capital gain distribution estimates and record dates. If a fund signals a large distribution, decide now whether to exit before the record date or hold and offset with banked losses. Review any upcoming large expenses and pre-decide the cash source, Roth or cash reserve by default. October 1st to 15th checkpoint. Lock the calendar. Compare year-to-date actuals plus scheduled items against your target. After October 15th, enforce your freeze on elective income. No late-year conversions, no discretionary IRA withdrawals, and no taxable fund switches unless you verify distribution dates and still have room beyond the full buffer. If you need cash, tap Roth or HSA reimbursements. Open enrollment, optimize non-IRMAA costs. Use the Part D plan finder with your current medications and preferred pharmacies to pick the lowest total annual cost plan. For Medigap, review premium increases and shop identical lettered plans across carriers if your state allows switching. Ask about household and EFT discounts. Confirm your doctors and hospitals if you're on Advantage. And check the out-of-pocket maximum for a bad year scenario. November, tax hygiene. Harvest remaining losses before distributions. Realize only essential gains within your cap. If you're 70 and a half or older and charitable, schedule QCDs early for next year, so they reduce RMDs from the start. If widow/widower status is possible, pre-model single filer thresholds and widen next year's buffer now. December final, verify projections against actuals. Save your spreadsheet gain/loss reports and fund notices. Note any surprises and their fixes. Set next January's calendar reminders for thresholds, the March checkpoint, and the October freeze. A clean checklist run each year turns IRMAA into a managed number, not a landmine. Microstory, the 12-month turnaround. A couple I worked with, let's call them Carol and David, did everything right. They retired at 64, enrolled in Medicare at 65, and kept a tidy spreadsheet. Then they made 2 moves in the same fall, a sizable Roth conversion to get ahead of RMDs, and a cleanup sale of an active mutual fund that was underperforming. 2 years later, their Social Security deposits dropped. Both Part B and Part D surcharges hit at once. They didn't change doctors, take new meds, or have a health scare. It was the calendar. When we sat down, the first thing that clicked was the look back. Their 2023 moves were pricing their 2025 Medicare. The second click was the cliff. They hadn't exceeded the tier by much, hundreds, not thousands. But A full year of 2 surcharges times 2 people felt like a penalty box. Stress spiked because they didn't know if it would happen again. We started with measurement, not magic. They pulled the last 2 tax returns. We built a 1-page MAGI tracker listing every income source, including tax-exempt interest they'd always ignored. We added a 5% buffer below their target tier and set a hard freeze on elective income after October 15th. Then we rerouted cash flow, safe harbor monthly draws under the tier, Roth for any top-up spending, and a 6-month cash reserve to avoid December sales. Next, we defused capital gains. They moved from the active mutual fund to broad market ETFs, in Taxable, turned on specific lot ID, and harvested a modest loss to bank flexibility. We put rebalancing inside their IRAs and Roths. For charity, they were already giving. At 70.5, they started Qualified Charitable Distributions to shrink the future RMD impact without touching MAGI. The rule was simple: QCDs first, then standard giving if needed. We also staggered withdrawals. Instead of taking one big IRA distribution late in the year, they spread smaller withdrawals monthly to keep a steady pace. When a car repair popped up, they used Roth. When a grandchild's tuition needed a boost, they tapped high basis shares in Taxable, offset by the harvested loss. Every decision asked, does this raise MAGI? If yes, we found a different source. The turnaround showed up fast. The next look-back year came in under the tier. When their new IRMAA letter arrived, surcharges dropped back to base. They didn't cut lifestyle. They tightened timing. In dollars, they saved several thousand the following year and stabilized their monthly cash flow. In stress, they went from "we're being penalized" to "we're steering the ship." Here's what clicked for them. You don't need a flawless tax plan. You need a calendar-aware plan. Measure MAGI monthly. Keep a buffer. Freeze elective income in the fall. Use Roth and QCDs as tools, not afterthoughts. The reason it worked is boring discipline, not financial acrobatics. And boring wins this game. Key takeaway: design your retirement income around IRMAA thresholds with a buffer, track MAGI, and control timing when income lands determines what Medicare costs. Grab the IRMAA-Safe income planner linked below. Then watch my follow-up on Roth conversions without triggering surcharges. Subscribe for weekly Retire Smart tactics, and share this with a friend approaching Medicare so they can avoid the same traps.